With almost $10 trillion worth of assets under management globally, private market investors are in a powerful position to catalyse change in line with the Paris Agreement and the required pathways to net zero. Specifically, by influencing their portfolio companies to reduce their overall financed emissions, there's a significant opportunity to accelerate decarbonisation. However, private markets are opaque, and investors have traditionally been reliant on ESG ratings and proxy data to understand the carbon profile of portfolios. With the global backlash against greenwashing, public demand for accurate information, and the emergence of standardised methodologies for measuring and reporting, such as GHG Protocol, TCFD and PCAF, this information alone is no longer sufficient. Adherence to these standardised methodologies, which facilitates investors to be Paris-aligned, will require highly accurate company or at least sector-specific measurements. Additionally, this information will also be paramount in allowing private market investors to align their portfolios with optional initiatives such as the Net Zero Asset Managers and the Paris Aligned Investment Initiative.
StepStone is a global private markets organisation. We have over 23 offices worldwide, and we allocate and invest in private markets globally. So that means that we invest in everything from private equity, from venture capital all the way through to mega buyout, private debt, real estate, and infrastructure and real assets, so things such as agriculture and forestry. Back in 2019, the firm committed to being carbon neutral, and it has been a continual process and journey since then. When we think about what's next for StepStone with respect to emissions, clearly within our carbon footprint, the big component within Scope 3 that we've yet to address is the Section 15, financed emissions, which ultimately are our portfolio holdings. Now, this, for an organisation the scale of StepStone, we deploy over 70 billion annually, or certainly did last year. We've got a big scale issue here, and this is clearly the journey that we're all on. Private markets are really well positioned with respect to addressing climate change. We have a long time horizon for our investments. We have investment managers that are skilled in getting businesses to act and behave in manners to increase their value. When we think about climate change is the giant risk and opportunity facing most businesses globally.
But as we all know, private markets are traditionally very opaque when it comes to surfacing data of any sort, let alone information on greenhouse gas emissions. For years, the use of proxy data and ESG ratings has largely been the only solution for investors who face a key challenge in knowing what data they need, when, and from whom.
So when we think of the key problem facing private markets and ourselves as a participant within that ecosystem, the key challenge is getting the data that we need to be able to assemble the carbon footprint.
ESG ratings are used to give an indication of how exposed a company is to environmental, social, and governance factors. What they don't tell you, however, is how emissive that company is and what it's doing to the planet. So absolutely, ESG ratings have a role to play in helping capital allocation decisions. But now that we have the science to show we need to be on a transition to net zero by 2050, we need to supplement those ratings with more accurate, company-level specific emissions data. It would be nigh on impossible for an investor to align their portfolio to net zero by 2050 using ESG ratings and proxy data alone. Quite simply, the methodologies that are prevailing at this time, such as the GHG Protocol, TCFD and PCAF, require much more accurate data. They do leave room initially for some proxy level information by region or by sector, but ultimately they're trying to get all market participants towards the use of actual emissions data.
We need the data ultimately from our portfolios, which means that we need it from the investment managers or the GPs, as the terminology goes within private markets. They in turn need the data from their assets.
Today, changes to our technology landscape have allowed for the extraction and easy sharing of accurate company-specific information between market participants, institutional investors, asset managers, and their portfolio companies. This information helps paint a clear picture of financed emissions across a portfolio and enables asset managers to best plan their transition strategy.
As an asset manager, if you're trying to work out how you go from your emissions today to your emissions in future and how you're going to influence that path, you need to have that communication with portfolio companies. And technology plays a role to enable you to have those communications happen securely across multiple parties all at once, but be able to view that all in one dashboard that actually shows you what's actually going on. Market participants are going to have to adapt. They're going to have to communicate a lot more. This is going to become far more interactive than it is today. It's not just reporting, which is one way. It's an interaction, which is two ways. Technology plays a very elegant part there to create those pathways by which the information can be shared securely, aggregated, analyzed at the kind of friction or cost and resource in the system that makes it feasible. Where today, if you try to service that entirely with consultants, that would be too expensive for us to actually get there at the end of the day.
Ultimately, private markets will have a key role to play in decarbonising the global economy in line with the Paris Agreement. To succeed, we need to augment traditional approaches such as ESG ratings and proxy data with accurate company-specific information. All of this will be underpinned by stronger connectivity between market participants who are increasingly reliant on each other for carbon data. Thanks to the advances in technologies, we're already taking significant strides to achieve this.
For the investment managers, the opportunity again is signalling that they are good custodians, that they are going to behave in a way to steward that capital to be contributing in a positive manner towards climate change.
Technology provides an amazing opportunity for investors trying to become Paris aligned and transition their portfolios to net zero, because it provides the efficiency you need for the data collection and analysis to surface the actionable insights that are so desperately needed. All market participants are going to need to adjust their actions and behaviours in the coming years to get us on a globally aligned path to net zero. From the largest financial conglomerates down to the single-person portfolio companies, everyone is going to have their role to play, and everyone is going to need to share information for mutual benefit. And connectivity is key for this, and this is where technology will aid that connectivity.